Our next speaker is Professor Joshua Long. Professor Long serves as Associate Professor of Economics at Indiana Tech in Fort Wayne, Indiana. Previously, he served on the faculty of Ivy Tech Community College. His educational background includes a PhD degree from Capella University and an MA degree from Walsh College, and he is currently completing an MBA degree as well. He has chosen for his presentation this morning the following title, An Appraisal of the Fed's Monetary Policy. Let's welcome Professor Long.
Once again, it's a pleasure to be here at U of D Mercy alongside of some of my previous professors from graduate school, which unfortunately, I was counting the number of years, is starting to be in double digits now. Again, it's an honor to be here, and thank you to each of you for coming out on this rather snowy morning. I looked outside this morning and saw the snow and thought that all of a sudden it was almost Christmas Day, but no, we still have a few more days before we get to Thanksgiving. This morning what I wanted to do was talk a little bit about what's happening at the Federal Reserve, most importantly in light of the recent Federal Open Market Committee meeting, which occurred several weeks ago, right before Halloween. Not so much in terms of philosophical ideas, but simply to kind of give somewhat of a bird's eye view at first, and then to kind of dive in and take a look at a few of the nuggets inside of the last FOMC statement, and then take a look at the one. There is actually one contrarian voice on the FOMC at present, which which just caught my eye in the last few days, and I'd like to take a quick look at that, and then also take a look at prospects for future monetary policy actions by the Federal Reserve and at their next and final meeting of the year on December 16th. As has been discussed this morning, the recovery since the so-called Great Recession has been mild at best. Mild at best. Wanted to take a quick look at some of the dashboard numbers, which actually don't look too bad. But again, dashboard numbers can be a little bit deceiving when you dig down and take a look at some of the more micro, more localized events that are occurring. The first number, and I'd like to take a quick look at real GDP, unemployment, and then inflation as measured through the consumer and producer price indices. On the screen, you have some basic numbers for real GDP in the United States using chained 2009 dollars. These are dollars that have been adjusted for inflation back to 2009 levels. As you can see, over the last 6, almost 7 years into the recovery, real gross domestic product in this country has indeed increased over that entire period, about 14% growth if we use 2009 dollars. And again, just a quick run down memory lane for basic macro. GDP is equal to consumption, consumer spending, private investment, government expenditures, and then net exports. And as most of us know, net exports are negative. However, we have some positive activity. 14 divided by about 6 will give us, what do we have? 2% growth per annum there. So definitely below the norm for the last half century. So Plain English, weak recovery. As was mentioned by Mr. Weglars, the unemployment rate has indeed dropped. When I was preparing this PowerPoint, I actually went back to the St. Louis Federal Reserve's FRED system, their economic data system. I couldn't recall exactly when we hit the peak in terms of the unemployment rate. And it was actually at the very start of the recovery. Officially, the recovery following the last recession began in the third quarter of 2009, but unemployment, being somewhat lagging in this situation, didn't hit its high point until the very beginning of the recovery. And then 6 years later, we're down to a beautiful 5%. And also, as Mr. Weglars mentioned, that may not be as beautiful as it may appear at first glance, in part due to the labor force participation rate, which is at its lowest levels in 30 some odd years. So, the good news is on those first two indicators. On to the area that seems to have caught the Federal Reserve's attention most recently, and that's the area of inflation. And of course, some people prefer to talk about inflation in terms of price levels, and for the sake of argument, I'll stick with that definition, although many of us here would probably prefer to talk about monetary inflation. But for the sake of analysis, let's just accept the assumption of price inflation for a moment. So this shows, I wanted to pull up a quick chart that shows the consumer price index going back over the last 10 years. You can see that overall, if we go from start to finish, we have an increase in consumer prices, roughly of about 10%, I suppose, 11, 12%, somewhere in that range. However, in the last 12 months, consumer prices have been kind of hanging around a little bit. And if you take a look at the last little bit of that line, it's kind of going flat. A more drastic story is told with the producer price index, a more wicked ride. Whenever I look at this graph, it kind of reminds me of some of the roller coasters at Cedar Point. Hopefully your stomach is rigged for the ride, because these prices are much more volatile. You can see during the so-called Great Recession, we had a massive spike of inflation, followed by a massive spike of price deflation. And then we have another interesting trend going 11 through start of 14, kind of a ping pong effect, up, down, but relative stability for a few years. And then all of a sudden, we have this year, for the producer price index, we have a trend of deflation, of price deflation. I think this is one of the things that has caught the attention of the Federal Reserve, and in particular, the Federal Open Market Committee that we'll speak about in a moment. So again, an overview. From the Federal Reserve's point of view, good news with real GDP, good news. Looking at the overall unemployment rate, price inflation, not so good. I think this helps to provide an insight as to some of the interventions that Mr. Fisher referred to that they have taken and that they are continuing to take. Again, you may agree with these interventions, you may disagree with them, but it always helps to understand why someone is taking the actions that they have decided to take. And I apologize for the red font on this on this next slide. I believe I've shown this slide before. I mentioned that the Federal Reserve has taken some unprecedented actions ever since the financial crisis of '08 and the Great Recession of '07 through '09. And each of these are some of the expired tools or monetary policy tools that were used. And I'm not going to run you through each of these. That would be the topic for an entire graduate level course. However, each of these are red because they're expired. However, they have been used in the last few years. And I had to brush up on exactly what all these were. And I found a very quick description on the Board of Governors website, and they said that each of these tools, the Fed established various facilities to provide liquidity directly to borrowers and investors in key credit markets. So in the last 10 years, last 8 years perhaps, the Federal Reserve found a range of unconventional, unorthodox ways to inject liquidity directly into credit markets. And so the news is that each of these 8 tools or facilities are now off the books. And so there's a scaling back of some of the intervention that occurred. However, if you take a look at the Board of Governors website, they have a page where they show current monetary policy tools. The first 3 hopefully will look fairly familiar. Open market operations used to influence the federal funds rate, which catches much attention in the media, the discount rate, and setting reserve requirements. Show of hands, how many of you have heard of those before? Good. Good. However, the last 3 are highlighted in yellow because these are some less known tools. And in particular, the first, number 4, the first of the last 3, number 4, is a new tool that is not so well known, but this is a way that the Federal Reserve pays interest to depository institutions that keep required reserves or excess reserves on the books with the Federal Reserve System. So we always hear, oh, the Federal Reserve sets interest rates. Well, that's true. Which interest rates? Well, the federal funds rate, very, very high profile. The discount rate, somewhat high profile. And the one that's not seen very much is number 4. Number 4. I wish that this would be added to more macro textbooks. Again, these are just several, not only current tools, but also more particularly, these illustrate how the Federal Reserve is in the business of directly influencing short-term interest rates. Let's talk numbers just for a moment. I don't have any on the slide here. I believe the federal funds rate number was already mentioned. It's allowed to fluctuate between 0.25%, a rather low number. I believe currently it's actually 0.1 some odd percent. Do any of you know what the current discount rate is for primary markets? Take a wild guess. A little bit higher.
About 1%. About 1?
Yeah, it's just a little bit less, at 3/4 of a point. That's the one Federal Reserve interest rate that has increased slightly. It was a little bit lower a couple of years ago, and that was raised 25 basis points a while ago. Again, a low interest rate. Obviously, as many of you know, the discount rate refers to loans, short-term loans given when depository institutions borrow directly from the Federal Reserve. And one interest rate that I was aware of, but again, I don't see it a whole lot, is this interest on required reserve balances and excess balances. So basically, what this means in plain English, depository institutions, banks, do they want to keep all the money on their own books, or if they have currency in their own vaults? No. No, I'm not sure about you, but that's a recipe. If you have $50 million in currency back in your vault, I mean, that's an invitation to a good old-fashioned bank robbery. Yeah. So, as most of you probably know, the Federal Reserve serves as the banker's bank. And different depository institutions deposit either their required reserves or their excess reserves at their local Federal Reserve Bank. And so the Federal Reserve pays interest on those deposits. A fairly new type of intervention, I suppose. And I took a look at the date, and this particular interest rate was last changed in 2008, so we go back about 7 years there. Do any of you know what this interest rate is? Pardon?
2%.
A little bit less, a little bit less,
What they have.
a little bit less. I kind of feel like,
3/4?
a little bit less. It's kind of like a reverse auction going on here.
It's usually, since 2008, it was 2009 when the rule was established, hasn't it always been essentially double?
At least according
That's the
to,
shell game, right? That's,
well, we could talk about what it is, but or in terms of in terms of whether it's a good or a bad idea. Currently, this is set at least according to the Board of Governors website at 1/4 point. Again, a low short-term, in low interest rate, a low interest rate. Next, what I'd like to do is take a look at the very, very publicized current FOMC statement. Any of you can find this on the Board of Governors website. It's normally about a one-page document. And the goal is to provide some transparency, or the stated goal of this is to provide some transparency to not only the actions of the Federal Reserve, but their point of view. Their point of view. Several weeks later, the minutes of the meetings, which I believe were mentioned just several moments ago, the minutes of the FOMC meetings are made current, but after several weeks, it's somewhat old news. And frankly, I'm not sure about you. Whenever I try to read those, I fall asleep. So I prefer painful reading and very short doses. So I just found a couple of quick quotations from the current FOMC statement that provides some insight into the perspective of where the Fed currently is. The first quotation, and each of these are direct quotations from the FOMC statement. I tried to cherry pick these a little bit. First of all, it is the view of the FOMC, the Federal Open Market Committee, that economic recovery or activity is expanding at what they call a moderate pace. A moderate pace. I believe we could say a mixed bag, perhaps, and we'll see why in just a moment. The second quotation gives an insight into, I would say, their primary concern at this point. As was mentioned, the Federal Reserve has a dual mandate of price stability and full employment. And again, we can debate that until the cows come home, but that is the law of the land at present. As is mentioned in the second quotation, they mention how inflation is below the target rate. Currently, the Federal Reserve operates with a target inflation rate of around 2%. And by both counts, both the Consumer Price Index and the Producer Price Index, and also several other indices, inflation is running very, very low. At least what many of us would call price inflation. However, the Federal Reserve decided, as all of us know, they decided to maintain the federal funds rate and at its inside of its current 0 to 0.25% range. And again, this is a rather potent tool because this directly impacts the lending of one banking institution to another, or it's potentially potent, shall we say. So looking ahead to the fourth quotation, the Federal Reserve appears to be confident that inflation will increase. I'm not sure about you. I think that's a fairly safe. Bet in the long run, especially as we take a look at the consumer price index. Again, the consumer price index uses a reference point of prices. Its base point is the period 82 to 84. So if prices in 82 to 84 were 100, and today they're 238, you can do the math. Prices have more than doubled in the last 30 some odd years. So I think it's a pretty safe bet if historical trends continue that inflation will probably continue to increase in the long run. And that also seems to be the view of the FOMC. However, I think this is the kicker right here. The question then becomes, and the elephant in the middle of the room for many people, is how long will the federal funds rate or some of these other key interest rates stay at very, very low levels? Well, to make a long story short, the Fed says, well, we're not quite sure. We're not quite sure. They're holding the cards fairly close to the vest, so to speak. A lot of people say, well, December is the big month. We don't know for certain. However, this quotation says, and the part that seems somewhat curious is that even though some of our indicators are at getting closer to where they're supposed to be, economic conditions may for some time warrant keeping the target federal funds rate below levels that the committee views as normal in the longer run. So this is a hint that perhaps the federal funds rate, interest rates set by the Fed, may stay lower for a longer period of time. I think this is part of the FOMC statement that the media may and others may have missed. There's a very clear signal that some of these interest rates may stay low for a longer period of time. At the end of the FOMC statement, there is the committee takes a vote in terms of which actions should be taken. The vote is 9-1 in favor of maintaining a low federal funds rate, except there was one lone voice. I found this very, very curious. A gentleman that I'm not all that familiar with, Jeffrey Lacker, who was the president of the Federal Reserve Bank of Richmond. And he had a contrarian view of what the Fed was doing. And again, just a quick recap. The Fed has 12 different regions, and again, he's from Region 5, the Richmond region. And this gentleman will only serve on the FOMC for this year, and then as most of you probably know, there is a routine of musical chairs that occurs, and some of the membership of the FOMC changes every single year. Very, very quickly, because I'm sure most of you would like to have a break now, just a couple of things that Lacker pointed out in his contrarian view. I think one of these is somewhat of an interesting insight and may provide a lesson for the Federal Reserve moving forward. He points and observes that real interest rates, not nominal interest rates being the ones that are on the street, but once you adjust for inflation, even though inflation may be somewhat low, if you're already at zero and you have any inflation, real interest rates are going to be negative. So he makes an observation that that real interest rates have been essentially negative territory in the U.S. market for 6 years. Number two, he points to the low unemployment rate as being an indicator or a sign that it may be time for the Federal Reserve to engage in other types of policies, perhaps raising the federal funds rate. Next, these comments are from early September, but still in the last 90 days. He reminds, in this particular speech, he mentioned that inflation is a lagging indicator. It takes time for the Federal Reserve to collect price data in order to calculate what's actually happening with either the producer price index or the producer price index or any other price index for that matter. It's very interesting. He makes a reference. In this particular speech, he made reference back to the 1960s when the Federal Reserve maintained relatively low interest rates for a number of years. And in this particular speech, he reminded his audience that the Federal Reserve was attempting to maintain low employment. And he made the observation that low interest rates on the part of the Federal Reserve helped to contribute to the so-called Great Inflation of the 1970s. So we have one voice on the FOMC currently who is concerned about the possibility of inflation. As many of us know, there have been some interesting fluctuations in financial markets, not only in the United States but globally, this past year. However, this particular gentleman did not think that that any financial volatility would have more than, or in his words, he said that it would have at best a limited impact on economic fundamentals in this country. Some of us may debate that, but that was his view right there. But I thought it was interesting how we had at least one voice on the FOMC who's concerned about the potential of inflation and reminds us of a historical event in the not too distant past. So, conclusion in looking at the actions of the Federal Reserve. In the short run, it looks like the Federal Reserve will maintain consistently low interest rates until inflation rates increase. However, even after inflation, price inflation starts to increase, they may even keep interest rates low based on the verbiage that was included in the recent FOMC statement. In the long run, however, I think it's a pretty fair bet, and I think the FOMC and the Federal Reserve have stated that we can expect lower interest rates. So the next stop will be December the 16th. The FOMC will meet for its last meeting of the year, and then Lacquer will be off the FOMC, and we'll have a new rotation of representatives from the 12 regional banks. So when will interest rates, or will some of these key interest rates increase? Maybe as early as December 16th. Maybe further in the future. We don't quite know. Thank you.